Hey traders. Okay, so when I'm doing my research, especially when I'm doing my due diligence in searching for new or better brokers, one of the things I do is I jump onto Google and I will possibly even jump onto Forex Peace Army and do my due diligence in relation to the experiences that other traders have had with various dealer groups. And there's always a common theme that traders, when they're really battling most of the Forex brokers out there, the issues are generally related to them possibly not being aware of terms and conditions. But the bigger one, which you absolutely have control over, in my opinion, is being properly equipped with the right knowledge. And in most cases, traders really don't understand their products really well. And so in this video, what I'd like to do is to go in depth to some degree of the product that you're dealing with, which is in this case, currency pairs, right? Now, the first thing you're going to understand is um, what the impact or what does impact on these currency pairs. On one level is you've got all the institutional crap that's going on, so whatever the targets are from the IMF and the World Bank, to what the institutions are doing, the massive market makers are doing, their clients, and the transactions that they need to run. Then you've got the seasonal targets that happen, and sometimes they're monthly targets as well that need to be achieved. So, to most of you that may not be aware, let me just say this: yes, to a large degree, most of this stuff is controlled, right? And then you've got your speculation going in there as well. So, which degree or what quantity or what volume of money is going and directing money in a specific direction, that would be as a result of trade. So, retail traders, when I say we have very little impact on the markets, that's true to some degree, but then we also have impact because the amount of money you're putting into various parts of your charts will also help the market makers determine to what degree they will go in that direction in order to capture your money. So yes, as a massive group, retail traders do have some degree of impact on the markets, right? So that's one thing you can look at. On the flip side, it is to your strength to become aware of the fact that fundamentals also have a huge impact on the market. Brexit was one of those examples where when okay, let me draw back slightly. Let's talk about the US dollar right now. The greenback is to a large degree the central reserve currency of the planet, right? We all agree with that. What that means is that the vast majority of resources are dealt and exchanged with the US dollar. And by resources, I'm also kind of directing you to one thing in particular, oil. And if you look at many of the wars that the United States is involved in right now, it doesn't matter what you've been told by mainstream media, and without me going into too much politics here, a large part of those wars has to do with oil and the transactions to do with oil. Now, if you're looking at some specific countries like Libya, Iraq, and also Syria, the common theme here is, and this is right before the wars actually began, where the leaders of all three nations, they started to, actually not started to, some of them had begun, where they stopped dealing in their oil with the US dollar. Libya, Gaddafi actually had plans. He was well and truly into production of the African dinar, which would mean that most of the African nations will then deal with or exchange oil with for their dinar, and this was fully backed by gold because Libya did have a huge storage of gold. And the same stuff was happening in Iraq, and in 2006, Assad in Syria did exactly the same thing. He was leading towards not exchanging their oil with against the US dollar. And so as a result of that, the US economy or the dollar, the greenback, had to be protected, and that is the purpose of the wars. Now, here's another thing that will impact on us in some way, some shape or other, is that Iran has just recently said, for probably the umpteenth time, that they are no longer going to deal with or deal their oil in the US dollar. Now, they are not a major supplier of oil as compared to the rest of the world, but they still have some degree of impact. Now, how much this impacts US foreign policy at this stage, we're not sure of, because besides Donald Trump being a stand-up comedian at this stage, we're not getting very much out of them in relation to the response that the US will have to Iran, right? But what I can say to you guys is that whatever the response is will have an impact on your trade, or you trading forex. So just be mindful of that. And this is where I want you to be open, fundamentally speaking, to how the markets get impacted, or currency pairs get impacted, right? So just be mindful of that. Now, the other thing that we want to be very clear about in this regard is the impact that the US dollar has on all the other major currencies on the planet, and the impact that it has on commodities. So, say for instance, the US dollar is becoming stronger because the US economy is becoming stronger. What you're going to find is that the other main six currency pairs, or the other main five currency pairs, the majors are what you're seeing on my screen: Euro USD, USD JPY, Pound USD, USD CHF, which is the Swiss franc, AUD USD, and CAD USD, which is Canadian dollar, right? What you find is when the US dollar is strong, you'll get the euro, the Japanese yen, the pound, the Swiss francs, the Aussie dollar, and the Canadian dollar will go in the opposite direction. So you'll start seeing them fall, right? Similarly, you will possibly see the price of oil tends to hover, but because that's largely controlled by OPEC. But what you'll see is that silver and gold will take a dip as well. Now, with silver, it doesn't move that much, and so I don't actually trade forex with silver, but you can do binary trades with silver, and I will only personally do puts with silver. And the reason for that is that silver not only is a currency, but it's also used for industrial purposes, right? So they keep a very tight control on that. And so what I will do is to say correlation with the US dollar. If the US dollar is strong, silver is going to be slightly weaker anyway. And then you'll apply your support and resistance. You'll pretty much just look at wicks to the high before you will take your entries going south, that sort of stuff. Gold, when the US dollar is strong, most investors are investing back in the US dollar. So what you're going to find is that gold prices will fall. For us, that's the best time to be buying gold. And this is where you can do your forecast to say, what do you think will happen to the US dollar over a period of time, based on fundamentals that we just spoke about the wars and oil and all of that sort of stuff, and also looking at the present state of the US economy. Because when you study just this one economy, you can probably get some degree of idea as to what the rest of the world or the rest of the economies or even commodities are going to do. Commodities such as gold is probably a very sure bet, and the best times to buy them are when they're cheap, right? So that's how you'd invest in them, right? Now, the other thing to note, as I've said earlier, is that when you've got the US dollar strong, all the major currency pairs all the currencies, the five other major ones, will fall, right? When the US dollar is weak, those currencies go up. And this is in primary form, this is the correlation that I'm talking about. And that's what I want you to also start noting. So again, any currency pair that is not the US dollar and that is still part of the majors, so euro, Japanese yen, pound, Swiss francs, Australian dollar, Canadian dollar, and also commodities, silver, gold, what you're going to find is that they will fall if the US dollar is strong. They will climb when the US dollar is weak, right? And then you do your own homework in regards to what makes the US strong or weak. And we've already discussed some of those points. Then you've got, and before I go any further, these majors that you're seeing on screen, right? Why are they referred to as majors? Well, two reasons. One, because the US dollar is part of that currency pair. And anywhere that the US dollar is part of, in most instances, what you're going to find is there's going to be significant volume. And that leads me into the second point, where these pairs have by far the most liquidity when it comes to trading any pairs, right? You'll find more institutions that are dealing in these pairs. So again, a lot more liquidity that's going on, and at any given point, there's possibly billions of dollars being traded there. So be mindful of that. And if you are applying certain specific strategies and you just want them to be there to be a lot of volatility and a lot of liquidity, certainly go with them. Also note that when you're dealing with, say, proper ECN STP brokers, what you're going to find is that when it comes to majors, the major pairs, then the spreads on them are going to be very, very tight, right? So just be mindful of that, because a lot of traders I find that go out and complain about spreads with their brokers, well, they're not too familiar with the fact of spreads being dynamic, and also how spreads differ from when you're trading in majors, minors, or exotic pairs. Which then now leads me onto the minor pairs. Now, the minor pairs are any pairs that actually don't have the US dollar that's a part of them, but are also ones that are crosses to some of these pairs, right? So some of these currencies. So they are part of the majors, but they don't have the US dollar in them, right? What that means is the liquidity compared to majors is possibly lesser. However, it doesn't necessarily mean that those currencies can't move in the way that they would normally move. One of the things to note when it comes to institutional trading here is that when they're moving one of the majors, you've got to look over and consider the impact that a move with one of the majors will have on one of the minors, right? What do I mean by that? Is to say for instance, you were looking at Euro USD and Pound USD currency pair, right? These two. And say for instance, both the Euro USD and Pound USD is now heading up. On initial observation, that to me will say, okay, chances are that there's something weakened with the US dollar, and that's why both these currencies are moving up right now. But what you might find is that one is moving slower in relation to the other. So you might say Pound USD is absolutely climbing, and the Euro USD currency pair is slow to the mark. How you could actually structure your trade is then to go look at the cross pair, which would be this minor, the Euro Pound. And then you look to see of how this is moving, right? Generally speaking, what you will find is that if they're moving one of the other, they're going to stall another currency pair. So if these two are moving and one is moving quicker in relation to another, you'll probably see where this may just be going sideways, or if they say the pound is going up, then you'll see more wicks being produced. And it's almost like skid marks where they are flooring it, but the handbrake is up. So you're seeing a lot of smoke, you're seeing a lot of skid marks, but the market's not moving anywhere specifically for this. So this will give you more information as to what they're actually working right now. And that is a clear sign of big institutional moves, or market maker behavior as we refer to them. That's what's going on. And the miners, when you kind of start to understand this, the miners will give you somewhat of an idea of where the market is about to go, and that's your confirmation. Just another point of confluence there. Okay. Now, the other thing to note with the miners are that with your brokers, the spreads will be slightly higher than with your majors. Okay, and they're doing it so because literally they're covering their own risk. Right? There's probably lesser institutions out there. Now with the miners, you still will find a lot of liquidity out there, but there are lesser than when it comes to majors that are ready to provide quotes in exchange of these, right? The exotic pairs are referred to as the ones that are probably from emerging markets. So, the Singapore dollar or the ruble, one of them, you kind of do see them floating around, and I'm surprised when a lot of new traders trade those pairs, and then they'll go onto some of the forums and they'll start complaining about the massive the spread that the broker applied and start calling them a scam. But you've got to be aware of the fact that these brokers, when the liquidity does fall, they're going to increase their spreads. And so your strategy has to be such that if you want razor tight spreads, well, one, you need to deal with a proper ECN broker, in which case they'll probably charge you a commission on that trade. And in most cases, they're about $3, $3.50 or so per lot, or per standard lot. But if you do want to trade your minors, or you want to trade your exotic pairs, you're going to have to pay more in terms of spreads. Okay, so just be aware of that. And we're going to talk a little bit more about spreads once we get to this point, right? Now, the currency pair overall, what does it actually mean? A lot of people are throwing around, when we're talking about currency pairs, I'm trading the Euro USD, I'm trading the USD JPY, or Pound USD. But what is it exactly? What does that actually mean? So let's have a look at Euro and the US dollar, right? So Euro USD, most popular, probably the most liquid currency pair on the planet right now. The first part of this pair, so the euro, is considered or called the base currency, right? The second part is called the quote currency. You probably will hear notional as well, but the most common term for that is the quote currency. What does that actually mean, right? So if we look at the present price of the euro US dollar, let me write that down. So what are we at? We're at 1.05520. Okay? What does this mean? In the simplest terms, it basically means that this amount here is how much of this you need in order to buy 1 unit of the base currency, right? So this is your quoted price of how much of the quote currency, which is the second part of this currency pair, you need to buy 1 unit of whatever the base currency is, right? So the amount would in this case be 1.05520 US dollars is needed to purchase 1 euro at that specific moment in time. That's what we're talking about. So the same would apply to USD JPY, for example. In this case, JPY would be the quote currency and the US dollar would be the base currency. So the question would be, if you were to look at USD JPY, where is it? Here we go. Current price is 113.191. What that means is that you would need 113.193 right now, Japanese yen, to purchase 1 US dollar. Okay? And that's how you would consider what these currency pairs are. Now, what does that mean for us exactly? Okay, so let's look at it a little bit deeper. Let's say when you are buying this currency pair, the Euro USD currency pair, right? What you're effectively doing is you're buying the Euro and you're selling the USD pair. The USD currency, right? And that is when we're saying, okay, we're going to buy it, this is going to go up. And when you're selling it, we're saying it's going to go down. In binary, when you're doing a call, you're literally, well, not buying it literally, but you're betting on it. You're buying the euro dollar and you're selling the US dollar. In Forex, what you get is 2 prices, right? Or 2 words. The first one is called bid. So if I was to go here, okay, and click on Market Watch, what I'm seeing is the bid and the ask price, right? Let's look at Euro USD. Now, this for us here, okay, let's get out of here actually, let's just stay here. This for us here is the bid price and this is the ask price, right? And they'll differ slightly. What the bid price means for us is the actual buy price. And what that means is how much of the quote currency, which is the US dollar, will you need to buy 1 unit of the base currency. So that's the amount that you would pay. Actually, the best way for me to do it is this. That's the amount you will pay in buying, or how much of the US dollar you will pay to buy 1 unit of the euro, right? And you're saying that the market is going to go up, so you're buying the currency pair, right? The opposite of that is the ask price, right? And what that actually says is how much of the quote currency you will get to sell the base currency, which is the euro. Okay, hopefully that makes sense to all of you guys. And that is literally what we're talking about, the bid and the ask. Bid is always buy, and the ask is always sell. That's the difference in price. Now, when you're trading Nadex as well, this is the same terminology that you're going to get over there. And when you're looking at on the contracts, the bid and your ask, your literally bid is you're buying, and your ask is you're selling at that point in time. Okay, does that make sense? Hopefully it does. Okay, so let's use, say, for instance, Brexit as an example, right? When the news came out for Brexit that the Brits had voted to leave the European Union, what you started seeing was all the pound pairs, pound USD, pound JPY, they started tanking. And what that basically meant was that the amount of money that people, or the faith that people had in the present value for the pound was falling. And so in this case, when pound USD started to fall, and let's have a look at the pound USD, it basically just meant, and this is not what happened back in October, but we're going to use this as an example anyway. But basically what's being said was that, say for instance, at that point in time, you need to have 1.250099 US dollars to purchase 1 British pound, right? And then the result came out that they were going to exit, and what the market said was to say, okay, we think that this is going to have a detrimental impact on Britain because, largely fundamentally speaking, Britain would then have to go out and negotiate 20-something individual trade agreements with their European partners in order to maintain trade in the way that they've had it now, right? And so they're saying the resources, labor, and everything else available to them has fallen. So we're thinking that now, in order for me to purchase the British pound, it will probably require less US dollars, right? So the British pound started falling. And what we found was that instead of, say, for instance, 1.25004 US dollars for 1 British pound, the market absolutely tanked, right? And it fell by something like 1,500 pips or something along those lines, right? So what that said now, and again, just as an example, that instead of 1.25 US dollars for 1 British pound, what we now are going to pay is just 1.24 something US dollars per British pound. Okay, so when we come back to these examples here, what that literally meant for us with the bid and the ask price was that they started to fall, right? So you probably would have seen that actually spreads around there. Let's not go into that. That's going to complicate things a little bit more. Okay, so what else was there? Okay, let's go into spreads now. What you see here, the bid and the ask price, that literally is the difference, is your spread. That's the risk that your broker is taking in dealing with you. Now, with proper ECN brokers, what you're going to find is that those quotes are coming straight from the institutions that they're shooting this out to. Okay, so straight STP, straight through processing, basically means that your broker, whoever is initiating, whoever through whom you're initiating your trades, don't have a dealing desk, and they're really not jumping in onto your trade. They're not the counterparty to your trade. They are just the middle person who's negotiating for you, and in doing so, they're picking up either a commission or a very tiny spread, but that is then going to institutions out there that come back with their own spreads, right? In most instances, what some brokers may do is they will get whatever responses they get from the institutions to say, okay, we have our spreads here. They will then add their own spreads to make their own little profits, and then they'll offer that to you. Okay, most internal brokers, and what I mean by that is where they literally are the counterparty. They take on the other end of your contract. These guys will most instantly hike up the spreads. They won't charge you a commission, but they will hike up the spreads because that's one way of how they're going to make money. And the other way how they will make money is by hopefully manipulating your trades so that you lose the trades and they pocket your money. And so in that regard, that's why I say you got to do your due diligence. Look for proper ECN STP brokers. And make sure they're regulated. The best regulators on the planet, there's only two of them, so you can't forget. FCA in the UK and ASIC in Australia. Okay. The other thing that I wanted to talk to you about when it came to currency pairs is how you actually monitor pips. Now, a lot of people get confused because I think especially in binary options, you might see a movement of say 100 points. And a lot of the self-proclaimed gurus out there will say, hey, I'm so fantastic. My trade that I took here moved 100 pips. And what you'd largely find is that that's incorrect because the market's moved 100 points. See here with the ADR where it says 999, that's not 999 pips. That's 999 points of pipettes. I like to call them pipettes. The pips, it's 10 points is 1 pip, right? And the easiest way where you can calculate your pips is just go onto your MT4 platform, grab your crosshairs, hold it down to from 1 point, and then drag to wherever you need to do the calculations to, right? If you look straight in the middle there where it says 251, that also is calculating for you right now the points that the market has moved. So what you do is you come in 1 decimal point, and that now effectively becomes 25.1 pips that the market has moved. Okay? And that's how you calculate your pips. All right, now, so without making this video too long, I'm hoping that I've effectively given you a bit of information in regards to what currency pairs are and how they work and stuff like that, and some of the fundamentals. If you've got more in-depth questions in relation to this, then please just write it down below this video in the comment section, and I will try and answer them that way. Okay? All right, bye.